Hey everybody, Andre here in another general knowledge video. Now this is week 4, no, it's week 5. It's a bonus video in our mortgage renewal series. Last week I said I was done, but something came up that I just had to share. And in this video, we're gonna talk about an advanced mortgage strategy. Now we've been getting a lot of good feedback on these videos. My kids even been sharing them with her friends at university, and they've been finding them informative and helpful. So in honor of that, I pulled out my Western Dad sweatshirt to thank them for those likes and views. So here is, I'm not going to call it the $1 million question, but I am going to call it the $6,000 question. And if you stick around to the end, you'll know what I mean by that. So here's the question. We've learned about CMHC insurance in last week's video, and we learned that this is an insurance policy that the borrower actually pays for. They pay the premium, but the policy protects the lender in the event that the borrower defaults. And we also learned that if you put down 20% or more of the purchase price, you don't generally have to get this insurance. So if you don't need to get the insurance, and it protects the lender, does it ever make sense to buy the insurance in those circumstances? The answer is maybe. It depends on the math. We basically have to figure out, well, what does this policy cost, given the variables? And then we have to figure out or ask the question, if the mortgage is insured, how much of a better rate will the lender give you? Now, I'm going to assume for the purpose of this video, it's 0.25%. Of course, that would depend on market conditions and a bunch of other variables. But what I'm going to teach you more importantly is how we would work through this type of problem and figure out, does it make any sense? So here are the parameters I came up with. Let's assume it's an $800,000 purchase price, and you are putting down $300,000. So that would mean, well, we can do this math in our head, you would need a $500,000 mortgage. Now, if we divide $500,000 into, or by a purchase price of $800,000, we get a LTV, a loan to value ratio of 63%. Now I'm on CMHC's website, and it says up to and including a 65% LTV, the standard purchase premium is 0.60%. That's not even a percent, 0.60%. So if I plug into my calculator $500,000 mortgage times 0.60, and to make it really easy, I'm going to use the percent button on my calculator, equals, we get a premium of $3,000. And depending on your province, it might be a little bit more because they might apply tax to that. Okay, now let's head over to that mortgage calculator that we've been using. Let's plug the numbers into the calculator, first using, let's say, a 6% interest rate, and then compare it to what it would look like if we got a rate of 5.75%. Again, 0.25% lower because the mortgage is insured. Now, these aren't today's rates. I'm just using these as an example. So a $500,000 mortgage, let's start with a 6% interest rate, 25-year amortization, which is the total repayment period, payment frequency, a monthly I'm going to go with, and a 5-year term. I hit the calculate button. Now the payment is around $3,200. That's not really what I'm interested in here. If we go to the calculation summary under the term, the interest over the 5-year period would be $141,125. Okay. Now let's go back, and I'm gonna change that rate to 5.75. Again, assuming I get a 0.25% better rate because I'm paying the insurance to insure the mortgage. The interest costs would be $135,086 over the 5-year period. So the difference there, $141,125 in interest over the 5-year period at 6% versus $135,086 if I get the insurance, the difference is about $6,000. So I guess, do I want to pay $3,000 today in a premium to save $6,000 over the next 5 years? I don't know. It makes a lot of sense to me in that scenario. What do you guys think? Well, I'd love to see your comments in the comment section. Again, knowledge is power. Talk to your advisor about these types of strategies. They might even have some that obviously we haven't discussed. I'm not suggesting that you renew your mortgage or you take out a mortgage on your own. What I'm suggesting is the knowledge in these videos help you know what you don't know, kind of thing. You know, it educates you so that you can ask the right questions and seek advice from a qualified advisor. Thanks, everybody. I hope you found this video helpful, and good luck in securing your mortgages.